Interest rates are one of the most powerful forces shaping an economy. They influence everything from the cost of borrowing money for a home or car to the returns savers earn on their deposits. For businesses, interest rates can determine whether an investment is worth pursuing or if expansion should be delayed. For governments, they influence the cost of servicing debt and the pace of economic growth. In the United States, no institution has more influence over interest rates than the Federal Reserve, commonly known as the Fed. Understanding how the Fed sets and adjusts interest rates is key to grasping how economic policy works in practice. So in this video, we will discuss how the Federal Reserve affects interest rates. But before starting the video, be sure to smash the like button and subscribe to never miss out on any of our videos. The Federal Reserve's role in the U.S. economy. The Federal Reserve, established in 1913, is the central bank of the United States. Its primary mission is to ensure the stability of the nation's financial system while promoting maximum employment and stable prices. This dual mandate means the Fed is constantly monitoring economic indicators such as inflation, unemployment, and GDP growth. While the Fed doesn't set every interest rate in the economy, it uses powerful tools to guide the cost of borrowing and lending across the financial system. Its decisions influence short-term rates directly and long-term rates indirectly, shaping economic activity nationwide. Tools the Fed uses to influence interest rates. The Fed has several key tools to adjust interest rates and control economic conditions. The most prominent include the federal funds rate, open market operations, a discount rate, and reserve requirements. In recent decades, it has also used unconventional tools like quantitative easing and forward guidance. By adjusting these levers, the Fed can either stimulate the economy during slowdowns or cool it down during periods of overheating. Each tool works differently, but all are designed to influence the supply and cost of money in the economy. The federal funds rate, the benchmark for lending costs. The federal funds rate is the interest rate at which banks lend reserves to one another overnight. Although it may seem like a small specialized number, it serves as the foundation for many other interest rates in the economy. When the Fed raises the federal funds rate, borrowing becomes more expensive, discouraging spending and investment. Conversely, when it lowers the rate, borrowing becomes cheaper, encouraging more economic activity. Mortgage rates, car loans, and credit card interest rates often move in the same direction as the federal funds rate, although not always at the same speed. How rate changes ripple through the economy. Interest rate changes by the Fed have a chain reaction effect. When borrowing costs rise, consumers may postpone large purchases and businesses may delay investments. This cooling effect helps reduce inflationary pressures. On the other hand, when borrowing becomes cheaper, households and companies are more willing to spend, which can boost economic growth. The housing market, stock market, and currency values all respond to rate changes, creating a complex web of consequences that extends far beyond the Fed's initial decision. Inflation, unemployment, and the Fed's balancing act. One of the most challenging aspects of the Fed's work is balancing the twin goals of controlling inflation and keeping unemployment low. If interest rates are too low for too long, inflation can spiral out of control as too much money chases too few goods. If rates are too high, borrowing slows dramatically, businesses cut back, and unemployment can rise. This balancing act requires constant data analysis and often involves difficult trade-offs. The Fed's credibility depends on its ability to strike the right balance between these competing priorities. The role of open market operations. Open market operations are the Fed's primary method of adjusting interest rates. This process involves buying or selling government securities in the open market. When the Fed buys securities, it injects money into the banking system, increasing liquidity and pushing interest rates down. When it sells securities, it takes money out of the system, reducing liquidity and pushing rates up. This tool is highly effective in fine-tuning short-term interest rates and is used regularly to maintain the target range for the federal funds rate. Quantitative easing and tightening. In times of severe economic stress, the Fed has turned to quantitative easing, QE, a policy of purchasing large quantities of longer-term securities to push down long-term interest rates and encourage investment. This was a key strategy during the 2008 financial crisis and the COVID-19 pandemic. The opposite, quantitative tightening, QT, involves reducing the Fed's holdings of securities, which can raise long-term rates and slow economic activity. These unconventional policies show that the Fed's influence extends beyond short-term rates when extraordinary measures are needed. How the Fed communicates policy changes. The Fed's influence is not limited to its actions. It also shapes expectations through communication. After each policy meeting, it releases statements explaining its decisions and economic outlook. The chair of the Federal Reserve also holds press conferences to elaborate on these decisions. This transparency helps financial markets anticipate future moves, which can influence interest rates even before official changes occur. Forward guidance, a strategy of signaling future policy intentions, has become an essential part of the Fed's toolkit in recent decades. Real-world examples of rate hikes and cuts. History offers many examples of the Fed's influence on interest rates. In the early 1980s, under Chairman Paul Volcker, the Fed dramatically raised rates to combat runaway inflation, triggering a deep recession but ultimately restoring price stability. More recently, during the 2008 crisis, the Fed slashed rates to near zero to stimulate borrowing and spending. In 2020, facing the economic fallout from the pandemic, the Fed again cut rates to near zero and implemented large-scale asset purchases, helping prevent an even deeper recession. Impact on consumers, businesses, and investors. For consumers, interest rate changes directly affect the cost of mortgages, auto loans, and credit card debt. For businesses, they influence the cost of financing new projects or expanding operations. Investors watch interest rates closely because they affect stock valuations, bond yields, and currency movements. Even retirees are impacted, as rates determine the returns on savings accounts and certificates of deposit. The Fed's decisions reach into nearly every financial decision Americans make, whether they realize it or not. Global implications of U.S. interest rate changes. Because the U.S. dollar is the world's primary reserve currency, changes in U.S. interest rates have global effects. Higher rates can attract foreign investment, strengthening the dollar but making U.S. exports more expensive abroad. Lower rates can weaken the dollar, making American goods more competitive but potentially sparking inflationary pressures in other countries. Emerging markets in particular often feel the ripple effects of Fed decisions as global capital flows shift in response to changing yields. Criticism and limitations of the Fed's influence. Despite its power, the Fed does not control all aspects of the economy. Global events, fiscal policy, and private sector decisions can limit the effectiveness of its actions. Critics argue that the Fed can sometimes act too slowly, misread economic signals, or create asset bubbles through prolonged periods of low rates. Others contend that its policies can deepen inequality by benefiting asset owners more than wage earners. These debates highlight the complexity and imperfect nature of monetary policy. Looking ahead, the future of Fed rate policy. As the global economy evolves, the Fed faces new challenges in setting interest rates. Climate risks, digital currencies, and shifting global trade patterns may all influence how monetary policy is conducted in the coming decades. While traditional tools remain effective, the Fed may need to adapt its strategies to maintain stability in an increasingly interconnected world. What remains constant is the central role the Fed plays in steering the U.S. economy through both calm and turbulent times. The Fed's lasting influence. The Federal Reserve's ability to influence interest rates is a cornerstone of its role in the U.S. economy. Through a combination of policy tools, economic analysis, and clear communication, it shapes the financial environment in which consumers, businesses, and governments operate. While its decisions are not without controversy, the Fed's influence on borrowing costs, investment decisions, and overall economic stability cannot be overstated. Understanding how it works is essential for anyone seeking to grasp the forces that drive the modern economy. Thank you guys for watching. If you want more videos like this, make sure to like the video and hit the subscribe button, and we'll see you in the next video.